Wall Street Wrap-Up is supported by Bamboolas, featuring live music and coming soon, tapas and wine upstairs. Bamboolas, the heartbeat of Frenchman Street.
This week on Wall Street Wrap-Up, the government released the September jobs and unemployment report. We'll tell you what they said. It's the end of the first week, and the House of Representatives has no speaker, but the two in contention to be the second in line to the presidency is Representative Steve Scalise of Louisiana and Jim Jordan of Ohio. Treasury bond yields are increasing to their highest level since 2007. But why is this not a good thing? We'll explain. And how will the stock market reply to this week's jobs report and higher bond yields? And what will this year's Christmas holiday season be like with the economy and massive shoplifting occurring in major cities? Tonight, we'll be talking with John Stoltzfus. John is the Chief Investment Strategist for Oppenheimer Asset Management with over $28 billion in assets under management. Well, we're just getting started, so sit back and relax. It's Friday, and it's time for Wall Street Wrap-Up. Hi, welcome to Wall Street Wrap-Up. It's Friday, October the 6th. Well, the Bureau of Labor Statistics released their monthly jobs report for last month, and the stock market was expecting a workforce to cool and jobs to be between 175,000 to 200,000 in additional jobs. But the country, they picked up 336,000 new jobs. Now, normally that sounds good, but with a hot economy, the question is, will this force the Federal Reserve to continue to keep raising interest rates? Unemployment stayed unchanged at 3.8%. And the stock market rallied after a strong jobs data report coming after initially dropping lower throughout the day. Stock highs were in the communication services, in technology, and in healthcare. And the S&P 500 and the NASDAQ, they ended positive for the week, but the Dow Jones ended negative. And this week, the Dow Jones closed today down almost 0.3% for the week. The S&P 500, they closed up, 0.5% for the week. And the NASDAQ, they closed today up just under 0.2% for the week. And last week, we showed you how mortgage rates are affecting the housing market. Well, last Friday, we showed you how 30-year mortgages were just above 7.5%. Today, that 30-year mortgage rose over 2.5% in 1 week to now at 7.8%. So if you want to buy an average $400,000 home with 20% down from 2 years ago to last week, it would have cost you an additional $920. Today, 7 days later, that same house would have cost you an additional $965 per month. Well, why is all this inflation going on? Well, deficits are starting to matter. Now, many may not care about the debt or the deficit. Well, I get it, but many do care about higher interest rates. The thought is that Treasury bond yields have been rising because people are buying them. But this is a fallacy, because the yields or interest rates work inversely or opposite to bond sales. So now there's more supply out there than there is demand. There are two big reasons for this occurring. For 2 years, from March of 2020 until March of 2022, the Federal Reserve had been buying Treasury and mortgage bonds and putting this money into the economy. This was called quantitative easing. Now, after 2 years and over $8 trillion dumped into the economy, they're now reversing and doing what's called quantitative tightening, which is they're selling the bonds they had been holding. Well, there's a little problem, because now, at the same time, Janet Yellen, the Secretary of the Treasury, she also is selling an additional $1 trillion of more Treasury bonds to try to pay just the interest on the federal deficit. Now, that's reaching almost $2 trillion and rising daily. China and Japan were our two largest buyers of our debt, but they're now not buying as much as they did. And in fact, China is also selling treasuries. Add to this what the administration and Congress are presently doing, By passing the Inflation Reduction Act, green subsidies and tax credits, according to Goldman Sachs, will cost 3 times more than what was actually told to us just 1 year ago. And added with all the other spending programs in just the last 2 years, we've added an additional $8.5 trillion into the economy, along with the Federal Reserve selling the bonds that they had been buying. So why does this matter to Joe Sixpack? Well, that 30-year mortgage that we talked about is up almost 83% from last year. A used car will be just over 15.5%, and your credit cards are now just under 25.5% in interest on balances. So when a bond is purchased, it's called at par. It's for 100 cents on the dollar. So it would have cost the Federal Reserve $1,000 for a $1,000 bond. But because now there are so many bonds in supply, those same bonds bought at $1,000 are now being sold below par at 50 and 60 cents on the dollar. And by the way, on this day, on October 6th, back in 1979, on this day, Federal Reserve Chairman Paul Volcker, he raised interest rates a whopping 12%. Now, we're right now at 5.5%, but this eventually broke the back of inflation. But many watching may be either too young or weren't here in 1979. Ask someone who remembers 1979, how was it to buy a house, to get a loan, or credit card interest? Bond yields are rising higher to finance government debt. And how will this affect the stock market now that we're into the fourth quarter? Well, joining us tonight to answer these questions, plus his thoughts on opportunities in the market, is the Chief Investment Strategist at Oppenheimer Asset Management, John Stoltzfus. Hi, John. Welcome to Wall Street Wrap-Up.
Hi, Andre. Thanks for having me on the show.
John, I've watched you as much as I ever can whenever you're on different media. And I know at one time, even just as far back as maybe a couple of weeks ago, you were bullish for the remainder of the fourth quarter. And if I remember correctly, I think you were even thinking that the S&P 500 was going to be getting to around 4,900.
That's right.
Oh, okay, because I was going to wonder with the price of oil and strikes and, news events that have recently been happening. Are you still feeling that way?
Yeah, well, the 4,900 target was put in, as I recall, sometime around in July, ahead of the strikes and the jump that we've seen in energy prices. But it most certainly remains. We maintain it. Essentially, the economy is at a point where it's improving even as the Fed raises rates, and we see an opportunity for the market to move to a high of 4,900 this year.
Interest rates that the Federal Reserve charges banks is right now at 5.5%. And there are smaller companies, smaller businesses that are filing bankruptcies. Do you find that the economy is still growing, or do you think it's becoming more stagnant?
Well, we find that the economy is still growing. If you look at the Atlanta Fed, they've got, last I looked, the Atlanta Fed has a positive growth GDP number for the fourth quarter. And through most of this year, what we noted is that there was a lot of projection that things would be a lot worse than they were. And the resilience that the economy has shown based on consumer activity, based on corporate ability to navigate a tough environment, as well as the job story, all has shown that resilience that offsets some of the tightening that the Fed is doing. In addition to that, I think we're the only firm on the street that says the end of free money, it's a good thing.
We still have, between now and the end of the year, that we have 2 more meetings with the Federal Reserve. Do you think that they're just going to pause from now until the end? Do you think that they're going to raise, or do you even think maybe a cut?
Andre, I don't think we'll get a cut, but I do think that there is a question: will they extend this pause, or as they call a skip? They call it now. I talk about the way people spin things, but at any rate. We do think that another hike is possible this year. It's data dependent as the Federal Reserve. And the environment that we're in, we really see the Fed has been extraordinarily sensitive in the process of following its mandate and curbing inflation so far, with some remarkable success thus far, even against sticky inflation.
John, why is it that right now, with you're talking about bond yields, let's say the Treasury. Now, we're talking about 2-year Treasuries that are paying over 5%, and we're talking 10-year and 30-year Treasuries that are now paying over 4.5%, 4.6%, and higher. Why is it? And also, you know what also? There's now an inversion where the 2-year is paying more than the 10 and the 30 as compared to normally that would be the opposite. Should we be concerned on that?
Well, related to the inversion, I remember I've been in this business for 40 years, so I've been through every boom, bust, and recovery cycle since 1983, which is quite a collection of memories. Curve is simply reflecting the fact that the Fed has further to go in its efforts to curb inflation. We've got enough growth to show resilience, not a robust economy, but very much an economy that is right-sized for the current situation, going through what we believe is getting closer to the end of a Fed funds hike cycle, though we're not there yet.
Do you find that, there was a period where we were at like 8.5% to 9% inflation. Now we're about 3.7%. Is it easier to go from a 9% inflation rate, CPI, to a 3.7, to now going from a 3.7 to what the target rate of 2% inflation would be?
Yeah, I think to get to that 2% inflation target is going to be a little bit tough with the processes that we're going through, including the diversification away from one country-centric global supply chain, and having to essentially see the supply chain move to different countries, the challenges related to infrastructure, investment, factories, training people. All of this means to us that the inflation will likely be stickier than the Fed hopes, but not at the levels that we saw, when I was early in the business, when inflation was double-digit inflation and averaged around 9%. It was extraordinarily high. We've seen the Fed bring it down from a 9-10% level remarkably well, but I think the last portion of this road will require more work and likely a longer period.
I have heard you say in the past where you like certain sectors, such as you like technology, but also the industrials. In fact, if I remember correctly, you even said that the industrials is like the new technology. Do you still feel that way?
I certainly do. And in fact, the fact that we have this big goal to dramatically improve our infrastructure here in the United States to make our country more competitive. Industrial stocks, when I started in this business, were usually a lot of brass and glass and metal, magnetic tape, and all kinds of things like that. And today, sometimes you have some of those things, but in addition to that, there's all types of sensors and communicative devices that make industrial products much more efficient. And technology is deeply embedded in industrials, and industrials are key to things like energy generation, again, aerospace, and factory and equipment, including robotics, which is going to be linked to the developments in AI.
Here's a thought, John, and let's kind of combine the two, technology, industrials, and such. We've got the S&P 500, and of the S&P, of the 500 stocks, you've got those 7, and I know they've been called the Magnificent Seven, maybe the 7 horsemen of the S&P or others, and those are more technology stocks. I'm curious your thoughts of, let's say, Tesla, which is one of the 7. Would you classify Tesla as an automobile company? Would it be a technology company? How would you classify that?
Well, I have to set this with a disclaimer, because I manage money for the firm and managed products. We really let our analysts make recommendations on the stock. But okay, I can answer your question in the sense, Tesla to me looks like the hybrid of automobile as well as essentially a computer. If you consider that it can get an upgrade while it's sitting in your driveway, That's an extraordinary thought to somebody who's been in this business for 40 years and can remember. I can say this company because it's out of business now. I remember Wang Computer, which was a
Yeah.
separate item that was a word processor that you'd add on to your computer so that you could do word processing.
Yeah. Well, and that's a good point because I mean I've heard it compared to as it's a, and I'm talking about Tesla as a computer with wheels, and that's why sometimes it's allowed to have a forward multiple as more than say other automobile companies. But I'm thinking, okay, so let's like when it comes to sectors, like for technology sectors, do you think that the other 6 stocks of like the Magnificent Seven, those others, do they have more room to grow, or do you think that they're ahead over their skis right now?
We would have to think they've got a lot more to grow. Whether it's the companies that have the 2 major companies that have the operating systems that most of us interface with in the course of the day, whether it's in business or at home, or those that deliver streaming services, or those that are involved in social media and advertising. This is an era that we believe very much is a period that is parallel to where the automobile was in the early 20th century. When at that time, Henry Ford had mechanized the assembly line, he brought up the quality, and he had lowered the price, making it more affordable to many people, and it changed the way people lived. And we are already in that process with technology in the most recent 10, 15 years, dramatically so, and likely are going to have more changes. Will present, disruption, but it will also present, we believe, great opportunity.
What about oil? I know at one time you were very bullish on energy. So I guess my question could be, are you still bullish on energy, oil, and do you think that oil will be reaching $100 a barrel?
Oh, that's a great question. When it comes to energy, in particular oil, what we would note is the importance of fossil fuel in bridging the wide gap between fossil fuel where we are today and eventually a larger role for alternative energy. Seems to us to say that oil is here to stay for much longer, and likely with technology also could become even more of an integral part going forward. So yes, we are bullish on energy. We have at present time, after I think last year, energy stocks were up about, the energy sector was up about 59%, as I recall, 57, 59%. This year, it's a much lower percentage thus far of the importance of traditional energy, whether it's for home use, whether it's for the automobile, trucking, running factories, even if those factories are manufacturing electric automobiles, it's likely natural gas that will be utilized to power a lot of the, at least some portion of the factories.
John, that's a good point because I was reading about a story just recently where Legos, the children's Lego toys, well, they were trying to use other products other than petroleum to make Legos, and everything they tried other than petroleum, they found that the Legos were too soft, or the coloring was not right. That petroleum, that people, when they think of oil, gas, energy, they automatically think of just fossil fuels with engine driving cars. But there's so many other things that petroleum products and lubricants that are being used that energy is and should be here for quite some time.
Most certainly, and I'm sure the buttons on my shirt are probably made, they're plastic, so they're made with petroleum. They're not made out of seashells.
Very true. Yeah. John, what about when it comes to cash reserves? I had heard a while back that there was about $5 trillion at one time in cash sitting on the sidelines. But now banks are reporting that deposits are getting less. And I don't know, is that from the problem of people pulling out their money out of maybe smaller regional banks because of bank problems? Or is it because of inflation that people are needing the money that was sitting in there to pay for just regular necessities that are needed? Or are people actually investing with it through equities? Have you heard of it?
I think I think a great question. I think it's a little bit of all three things, depending upon the individual or the institutional entity. I think one thing is a lot of the smaller banks and concerns that people have about where they put their money. The thought is some people are buying treasuries. And the treasuries, of course, help the government pay its debt. And for those of us who live in high tax states like New York and California, my recollection, and this goes with the typical disclosures, I'm not an accountant. Please check with your accountant related to your particular needs in that area and tax in terms of responsibilities and taxes. But my recollection is that treasuries, you don't pay city or state taxes, generally speaking. And so as a result of that, they even got a little boost to the yield.
Do you see that with the yields?
Basis.
Well, as we were talking before about the 2-year paying over 5% and the 10-year and the 30-year paying over 4.5%. Do you see in the foreseeable future that these yields will be going even higher?
I think they might go a little bit higher. I don't think a heck of a lot higher. The delay factor of the actions of the Federal Reserve when it practices its mandate against inflation would tell us we're about we're close to 15, 18 months or so into this hike cycle. The thought is that the overall effect is gathering momentum, and I think we've seen that in the last jobs report. We'll probably see it in this report, where we'll see things, the numbers come down somewhat while still showing resilience in the economy in terms of having plenty of jobs for people who are looking for jobs.
What about the debt? We're right now at about 32 trillion and climbing. Does the yield on a treasury, does that have anything to do with the debt that is owed?
Well, I'm afraid it does. And the issue, by the way, of the debt is something that quite often when we speak, whether we speak with institutions or we speak with private investors or with members of the press like yourself, it always comes up. And what we like to say is, the problem is that from the position of a strategist, there's not a heck of a lot we can do in terms of changing that, but we can certainly respond to it in terms of the type of investments that one might utilize to at least offset one's concerns and navigate what essentially is a gauntlet for our country in reducing the volume of spending that we do here. There just is a necessity to watch because you just can't spend into infinity. And it is going to be very tough to get politicians on both sides of the aisle to address the spending. And what we suggest to investors and institutions is start communicating with your representatives and tell them your concerns and vote with your concerns is what we would add. But that's as far as we can take it, because as the chief investment strategist Oppenheimer, when I speak in this capacity, I am politically agnostic.
Completely understand.
So I offend all sides.
Well, has the market priced in the $32 trillion of debt? Do you think that because of the fact that just last week, over the last weekend, the Congress raised the debt ceiling, does any of this play into the stock market?
Well, I really think that it certainly is priced in for the day. Let's put it that way, for the moment, and it's something the market is living with now for many years. I mean, when you go back, the U.S. debt has been notable at different points. I can remember when I first got into this business, it had been, and then I think it was during the Clinton administration, there was a point when all those electronic tickers that were running in different cities showing our debt suddenly disappeared. One even broke here in New York City, but it wasn't of great concern because we were in good shape. And then all of a sudden,
it broke the ticker.
I think they have. It also may have been that it was an analog piece of equipment versus digital, as the old. But when it gets bad enough, we tend to move, and people are talking about that debt everywhere I go. whether they are conservatives or liberals or a variety of other beliefs and thoughts.
John, what about we're we're into the fourth quarter, and that's part of the holiday season where retail is their time to shine. But right now, there's a lot of crime in the retail sector that is occurring. Well, for two things, what do you think the retail holiday season will be for the retail? And also, do you think that this is going to be hurting the retail sector of stocks bad with what's known as shrinkage, or as what I call shoplifting?
Yeah, I know the shrinkage is an interesting euphemism, isn't it?
It sure is, right.
And similarly for retail, it really depends upon what type of retailer we're talking about. Who are their customers? Where are their customers in the cycle? Are they still enamored with experiential events, or are they looking for a particular product that they will chase other people around the store to make sure they get theirs, before somebody else does for the holidays? We have to say it really depends, and we think throughout this year, when it came to the consumer discretionary sector, there were some retailers that had the right balance between e-commerce and bricks and mortar. That they actually produced good results, and there were others that got really hit bad. Policy and location related to the shrinkage business also affected earnings in more companies than one feels comfortable about. That's a question that needs to be dealt with at the level of local and state governments and how crime is dealt with.
John, I've got a lot more things to ask, but I hope you come back for part two.
Thank you very much for having me on the show, Andre. I enjoyed our conversation immensely.
Thank you, John. Hey, if you've got a question or maybe a comment about the show, we'd love to hear about you. Make it concise, make it piffy, and write us at andre@benecapital.com. Well, major banks are reporting their earnings for next week. Treasury yields are rising. Are there more regional bank defaults in the horizon? And how will the deficit affect a recession and stocks? Next week is a show you do not want to miss. So if you saw the movie The Big Short, it won Best Picture, in fact, a couple of years ago. Actor Steve Carell portrayed investor Steve Eisman, who shorted the housing market in 2008, and he made millions. Well, next week, Steve Eisman, the real Steve Eisman, not the actor, will be here. Does he see another bank meltdown as in 2008? That's Steve Eisman next week. And that's a wrap-up for our show this Friday, October the 6th. Our thanks to John Stoltzfus for being with us tonight, but always we appreciate you for allowing us into your homes this evening. Have a fun weekend with the ones you love. I'll see you next week. And remember, if it's Friday, it's Wall Street Wrap-Up. I'm Andre Laborde, and also remember, money never sleeps. Good night.
Wall Street Wrap-Up is supported by Bamboolas, featuring live music and coming soon, tapas and wine upstairs. Bamboolas, the heartbeat of Frenchman Street.